Welcome back, folks. In the current presentation we're going to show you how to estimate beta. I'm going to consider a small market of a small number of stocks. We're going to do some regression analysis, and I'm going to toggle back and forth between some Excel and PowerPoint presentations. There is two versions of the PowerPoint slides on the website, and there's two versions of the Excel files. So the idea is that there is a before class and an after class version of the PowerPoint and the Excel files. So you can work your way step by step through the spreadsheets and the PowerPoint presentations to replicate the final output. If you just try to look at the PowerPoint presentations, you won't know how to estimate beta. The only way to understand how to estimate the inputs into the capital asset pricing model is to estimate the inputs in the capital asset pricing model. You can't learn to drive a car by reading a book on driving a car and then turn up to your driving test and drive the car. It's not going to work. You can't estimate beta by reading a book about how to estimate beta and then turn up on a test and say, okay, here's what I'm going to do. We're going to have to do some practice. So I'm referring to the before class version of the PowerPoint presentation now, and here's our application. Suppose there are just three assets you can buy, shares in Nike, Merck and Boeing. Recall we used the same information in a prior presentation. You have a file showing weekly returns on each share. That is the percentage change in the share price plus any dividend yield in that given week, that is dividend divided by price. And the market weights are 20% in Nike, 45% in Merck and 35% in Boeing. The market return is a weighted average of the individual stock returns. So pretend, for the purpose of the illustration, that these are all of the stocks in the whole market, Nike, Merck and Boeing. Each group of students, in class we would have broken this up into different groups, is going to estimate beta from one stock, Nike, Merck or Boeing, and we're going to do a regression of stock returns on market returns by defining a week as Friday to Friday. We're going to use four techniques to estimate beta. We're going to draw a scatter plot in which the dependent variable on the y-axis is stock returns and the independent variable on the x-axis is market returns. Beta is the line of best fit through that scatter plot. We also can perform regression analysis by going to the Data Analysis tab and selecting regression as one possibility, or we can use functions within Excel. There's the slope function in which we input the y values and x values that you can see on the screen, or we can combine two functions together. We are going to take the covariance of stock returns with market returns divided by the variance of market returns, and they're all going to give us the same answer. If we compute a weighted average of the beta estimates, you'll see that it's always equal to 1, which is going to happen by construction. So let's do this. Let's put the beta estimates in this table using weekly returns for 3 different time periods. So let's do a beta estimate for Nike. I'm going to go to the before class version of the presentation, and I'm going to look at the data for Friday to returns. So the data tab says data SMFR. That tab stands for the data that's applicable to our small market using Friday to Friday returns. So if I zoom in a little bit, you'll see that for a long time period, I have the weekly percentage returns that I've already computed for you on Nike, Merck and Boeing, and for the entire market. So the first thing I'm going to do, looking at my PowerPoint presentation, is I need the beta estimate for Nike using a 5-year time period from 22nd of March 2014 to the 22nd of March 2019. And I'm going to estimate the beta using these 4 techniques. The easiest one to illustrate is going to be the scatter plot. Okay, so here's what I'm going to do. I'm going to check my time period, March 14 to March 2019. It's going to be down the bottom here. So looking at my scatter plot, I'm going to find the data period from March 2014 to March 2019, and I'm going to highlight some cells. I'm going to go to March 28, and I'm going to highlight all the cells for Nike, and I'm going to use some shortcuts here. I'm going to use Control-Shift-Down to highlight all of those cells. Then I'm going to hold my finger on Control, and I'm going to highlight the market cells, again by doing Control-Shift-Down. So you can see, taking my hands off the keyboard, that I have now highlighted two columns. I want to do a regression of stock returns on market returns. So my stock returns for Nike are going to be the dependent variable, the Y variable, and my market returns are going to be in column E. To do my scatter plot, I'm going to go to Insert and look at the charts, find the scatter plot section, and I'm going to select the scatter plot in the top left. And a scatter plot has appeared. This isn't the right scatter plot. I have to make sure that my X and my Y variables are correctly specified. If I click on the data, you'll see in the formula bar there is two series of data. There's a series in column B and a series in column E. We need the X variables to be specified first. The X variables, the independent variables, are the market returns each week. So I have to change the B reference to an E reference. So I've got the X variables specified first. If I hit Enter, here's my scatter plot. The horizontal axis represents market returns. The vertical axis represents stock returns. And each of those data points is an individual week. To find beta, I have to click on the data. In fact, I have to right-click on it, and I have to add trend line. And that produces a line of best fit. Now what the computer is doing is working out the line, the slope of the line, and the intercept, where this line plots on the vertical axis, to minimize the sum of the squared error terms. An error term is the difference between the line of best fit and an individual data point. So each of these gaps between the line and a weekly return, that's an error. That's because there is events affecting Nike which cause price movement to deviate from market returns. The computer has very cleverly and quickly worked out what intercept and slope minimizes the sum of all of those squared differences. If I display the equation on the chart and display the R squared on the chart, I've got some information. That information says that Y equals 0.76x plus 0.0009. 0.76 is the beta estimate for Nike during that sample period. That equation says that Nike stock returns is equal to 0.76 times market returns plus 0.0009. The R squared of 0.29 says that during that sample period, 30% of the week-to-week movement in the Nike share price can be attributed to week-to-week movement in the market returns. That means the remaining 70% of the Nike share price movement is explained by something else, explained by factors affecting the apparel industry or factors affecting Nike in particular. So that's how we do a scatter plot. And you can see if I toggle over to our after class analysis and I click on the solution tab that says Nike scatter FR, that stands for the scatter plot for Nike for using Friday to Friday returns, that's the chart that we should have produced, and it's the identical chart. So that's the first way we can estimate beta, by doing a scatter plot. Now, that's okay as far as it goes. It gives us a visual representation of the relationship between stock returns and market returns. But it doesn't work so well if we actually want to use these beta estimates in computing the cost of capital for many companies. You don't want to do a scatter plot for 30 companies if you had 30 companies in a comparable firm set and then write down all the numbers. You need some pre-packaged way of doing this really quickly. So another way we can estimate beta, turning back to my PowerPoint presentation, is to perform regression going to the data analysis tab. So going back to my before class spreadsheet, let's do the analysis in a different way. I'm going to go to Data, and then I'm going to click on the Data Analysis tab on the top right. If I click on Data Analysis, there's going to be a dialog box open. And if I scroll down the bottom of that dialog box, I click on Regression. I hit OK to Regression, and another dialog box opens, and it's going to ask me for some information. It's going to be asking me for what's in the Y range. That's the weekly returns on Nike. And I'm going to highlight the cells from March 2014 to March 2019 using the same rows we had earlier. And those rows are 1306 in column B all the way to rows 1566. The dialog box wants the X values as well. I'm going to highlight the cells in the market section, again using the same rows. I'm just going to type in some numbers, and then I'm going to change the first number in the dialog box. So this tells me that I want to regress cells B1306 to B1566 on E1306 to E1566. If I wanted to, I could set the intercept to be equal to 0, but I don't want to do that in beta analysis. You can just leave it as a normal regression. If I had labels in the top of these cells, I could specify labels, and I could specify some other output from this regression analysis. I don't need that for my beta estimate, and we're not doing everything in this class, so I'm just going to hit OK and have a beta estimate come out, as well as some other information, into a new worksheet. If I hit OK, what you can see here is the same information we had in the scatter plot. Let's check. The X variable coefficient is 0.76. The intercept is 0.0009. And the R squared is 0.2984. So we've got the same output that we would have had from regression analysis, but now that output is in a cell, and I could link that cell to some other analysis that I'm doing. Okay, so that's the second way we've estimated beta, by performing regression analysis in the data analysis tab. But suppose you want to do that for many firms, right? And you don't want to do that over and over again manually. We can use the slope function. Going back to my data tab, I'm just going to type in a function that says equals slope, open parentheses, then I'm going to highlight the same cells. We wanted rows 1306 to 1566 for Nike. Those are the Y variables. And we want rows in column E 1306 to 1566. Those are the X variables. So my slope function says regress column B on column E, and if I hit enter, the slope is 0.7607, the same as we had with the scatter plot and the same we got from our data analysis tab. I could also, I'm just going to lock in those cells by putting $signs in front of the rows in the column. If I want to verify I've got the same R squared, I could write equals RSQ. That number's 0.2984. And if I want to find the intercept from that regression, I could just type equals intercept and refer to the same rows and columns, and that figure's 0.0009. So again, we have verified that we're getting the same intercept, slope, and R squared by using these functions in Excel to estimate beta. Finally, we said that beta can be estimated as the covariance of asset returns with market returns divided by the variance of asset returns, of market returns. So let's put in functions for covariance and variance and verify that we get the same answer. You're going to see I'm going to use COVARIANCE.S, and that means we're referring to a sample of data. And VAR.S means we're referring to a sample of data as well. So here are the functions. I can write COVARIANCE.S of Nike returns going from cell B1306 to B1566 on market returns going from rows 1306 to 1566. That tells me that the covariance of Nike returns on market returns is equal to 0.000344. If I do the same analysis but just have variance, VAR.S, and of course just refer to the market column, I'm going to get the variance of returns on the market portfolio. That's going to be 0.00045. And if I take the ratio of covariance of Nike returns with the market divided by the variance of market returns, that ratio is going to be 0.7607, the same as we had from our other techniques. So we have verified how we can estimate beta for a stock using 4 different techniques. Another function you might find useful, instead of covariance, I could have written correlation, COR. You don't need to use .s when you have a correl as the equation. The correlation between Nike's returns and market returns is 0.54628. Recall that covariance is correlation times standard deviation of returns on one asset times standard deviation of returns on the other asset. I have correlation of 0.5428. If I had the standard deviation of Nike returns, that's 0.0296. If I had the standard deviation of market returns, that is 0.0213. And if I take correlation times the product of the 2 standard deviations, that gives me the same covariance that we computed earlier. So we verified that covariance gives you the same answer as correlation between a pair of assets times the product of their 2 standard deviations. So if we repeat those computations for Nike, Merck and Boeing using different 5-year time periods, these are the estimates that you get. I'm referring to the after-class version of the PowerPoint presentation now. If you then take a market capitalization weighted average of those beta estimates for Nike, Merck and Boeing during any of those time periods, you can see that the market capitalization weighted average of the beta estimates for all of those stock is by construction equal to 1, because in this instance that was our definition of the entire market. Interesting though, you start to get a flavour that the beta estimates bounce around a lot in different time periods. During the most recent time period, Boeing has a beta estimate of 1.25, so it's the highest risk stock. During the earliest time period, Merck has a beta estimate of 1.14, it's the highest risk stock. And the Boeing systematic risk is about 20% to 25% lower during that earlier time period. For these companies, their basic business model didn't change from one 5-year period to the next. Nike was still selling shoes and apparel, Merck was still selling pharmaceuticals, and Boeing was still putting people on selling air parts. Their basic business model hasn't changed. Their cost structure didn't really change. All that's happened is that in different time periods, there is noise in the historical data, and that shifts the beta estimates from one estimate to another. Turning to our before class version of this spreadsheet, the spreadsheet says put your scatter plots here. That's what I'm displaying on the chart. So you can see how the Boeing scatter plots using Friday to Friday returns and 5 years of data, those scatter plots and beta estimates have shifted quite substantially during that time period. Now remember, this is going to be important in your estimation, your valuations, because suppose that you had a market risk premium estimate of about 6%. It's a normal number. That's a number that lots of analysts would use. If one analyst had a beta estimate of, for example, 1 for Boeing, beta times the market risk premium of 6% would be 6%. If another analyst had a beta estimate of 1.4 for Boeing, 1.4 times the market risk premium of 6% would be a number of 8.4%. So going from analyst 1 that had a beta times market risk premium of 6% to analyst 2 that has beta times market risk premium of 8.4%, that's a 2.4% increase in the discount rate. And you already know from your valuations we did early in the class on projects and companies, that sort of change in the discount rate can have substantial impacts on the present value of expected cash flows. And this is why it's important to understand there isn't one true beta for any company. There are just beta estimates. And you want to use lots of data and lots of firms to mitigate estimation error. Let's go a bit further. Let's repeat the analysis on our stock using Tuesday to Tuesday returns. Now, I'm not going to run through that here. All that you have to do is repeat all of the steps that we did previously on each stock using a different data tab that refers to Tuesday instead of Friday. Now, I recommend that you practice it. I recommend you practice this using and compute all these beta estimates using all the techniques because it's important that you know how to do them. Right? In the moment when someone asks you to do that task in practice, you actually want to know what you're doing immediately and not have to have it, some recall in your mind that might take you hours to resolve. So practice it. And if you do practice it and repeat those computations, here is the answers that you'll get. What the figure table shows is that the Nike estimate for beta, depending upon whether you used Tuesday or Friday returns, could vary substantially in one particular time period. Look at these two numbers here. 0.65 and 0.82, depending upon whether you chose Friday to Friday as your definition of a week or Tuesday to Tuesday as your definition of a week. Look at the figures for Boeing in that same time period, 1.22 versus 1.38, or even for Merck, 0.98 versus 0.79. Now, in computing these beta estimates, nothing's changed in the economy, nothing's changed in the companies, and it's the same time period, same data period under analysis. All that's happened is that one analyst likes Tuesday, right? Tuesday, it's Taco Tuesday. Analyst likes tacos. Another analyst has a steak dinner on a Friday. And that analyst likes Fridays. And they sit down at the computer and they perform a regression, and the Tuesday analyst comes up with a beta estimate of 0.65, and the Friday analyst comes up with a beta estimate of 0.82. And if you apply those to fairly typical assumptions, a risk-free rate of 2% and a market risk premium of 7% in our model, they would come up with very different estimates of the cost of equity. The Tuesday analyst would say a fair discount rate for Nike would be 6.58%. The Friday analyst would say a fair discount rate would be 7.71%. And that could shift their valuations around by 5 or 10%, purely because of noise in the data. The key point is that you as an analyst are going to do all this great detailed work. You're going to understand the business model. You're going to understand profit margins and supply chains and customers. You're going to do all this detailed analysis. But then, purely based upon noise, if you don't mitigate the noise in some of this estimation error, you can shift your valuations around by potentially 20 or 50% as we accumulate lots of estimation error, purely because of noise that you can avoid by mitigating that error. Okay, so let's talk about how we might mitigate that error in this small market. Turning to our after-class version of the presentation, you can see how much the beta estimates and the cost of equity estimates have changed. The implication is that you want to use all available returns data, not just 5 years, and you want to repeat the analysis 5 times using different weekdays for the analysis. Now, we didn't talk about a minute ago how these numbers change from one 5-year period to the next, but you can see it's quite profound in the table. Take Boeing, for example. If you analyse data from March 2004 to March 2009, the cost of equity estimate would be 8.75%. If you repeat that analysis using later time periods, you could have 12% or 11% as your discount rate. The discount rate shifts dramatically. Is it shifting dramatically because of something truly changed in the risk of the company? Or is it shifting dramatically just because of events that happened, which are just noise in the historical data? There is a default setting in Bloomberg, for example. The default setting in Bloomberg is that Bloomberg is going to provide you with a beta estimate using monthly returns and 4 or 5 years of historical data. That default setting is going to give you a very noisy estimate of beta. You want to know why it's 4 years of data? Is because when researchers began analysing beta in the 1970s and 1980s, they needed to look at how beta estimates might shift as you go from one time period to another. The model was only developed in the mid-1960s, so these researchers had a fairly small window of stock returns they could look at, going from the availability of data in about the late 1920s to about 1970 or 1980 to analyse how beta might shift. They didn't have great computational power either. So what they did, these early researchers, is they said, we want to estimate how beta might shift from one time period to another. So we have to have enough shifts in a beta estimate, enough different time periods to actually do our analysis. So you know what they did? They said, we've got about 40 years worth of data. Let's break down 40 years into 10 4-year time periods. And that was useful for their analysis. They needed enough time periods to see how beta might change from one period to the next. But then practitioners ran with that. And they said, I guess we estimate beta over 4 years. And that has stuck. There's no science that says you analyse beta over 4 or 5 or 3 years, and that's optimal. Lots of people believe that if you use a short window, you get a very timely estimate of beta. That it's a really useful estimate because that's what's happening to the company right now. And what happened 10 or 15 or 20 years ago is irrelevant. In theory, that's true. But in practice, the main reason why beta estimates bounce around from one 4-year time period to the next is just purely random chance. It's purely because events that affected the stock on a week-to-week or a month-to-month basis during the historical time period may have happened to coincide with a period of rising or falling market returns during the same week or month. So the key point is that when you're analysing a company, there's no point at which the data becomes stale, unless you can say definitively that this company is fundamentally different to what it was before. And by that I mean, maybe the company sold off a division which was half of the revenue. Maybe the company entered into a fundamentally different business model compared to what it was before. There has to be a fundamental change in the business practice of the company. Not just, for example, Nike deciding, okay, now we're going to move into tennis rackets. Now we're going to move into golf clubs, for example. That's not a fundamental change in the business. But Nike saying we're no longer an athletic apparel company, we're now a personal training company or a live stream classes company like Peloton, that would be a fundamental change in the business. And then you would say, well, that past returns information is not relevant. So these following presentations, the slide deck basically takes you through the spiel I've been giving you. You want to look at all available historical information because the noise in stock returns is very large. In addition, when you're estimating beta for any particular company, don't just use that company. We're going to see more of that coming up, but don't just say, I've got the beta estimate for Nike, because your beta estimate for Nike could be contaminated by some weird stuff that happened to Nike during some particular week or month. You want to look at a broader sample of athletic apparel companies to make a beta estimate even for Nike itself. So here is how the analysis would look if you actually used all available information and you repeat the analysis using Monday to Monday, Tuesday to Tuesday returns and so on. So now I'm using 30 years of data and I've done the analysis 5 times and I've taken an average of the beta estimates from those 5 different estimations. And you can see that the beta estimates using Monday returns or Friday returns for each company, they're now very close. And even so, I'm going to minimize estimation error by taking an average of those beta estimates. You can also see that the cost of equity estimates across these three very different companies, an athletic apparel company, a pharmaceutical company, and an air parts manufacturer, the cost of equity estimates are really narrowed compared to the big dispersion of estimates that we had from this earlier table. We don't have estimates of 11% or 12% or 7%. Now the estimates are clustered within a range of 8.4% to 9.5%. And that's purely because we have now minimized estimation error. It doesn't take you any more time. Now, you can run a regression using 30 years of data or 5 years of data, same amount of time. And you can repeat that computation 5 times. Just use the slope function, drag it across 5 times, and use 5 different returns windows. Right? Monday to Monday, Tuesday to Tuesday, if you compile returns using different days of the week. It takes you almost no time to mitigate your estimation error, and your valuations will be more precise. That is the end of the presentation on a small market. In the next video, we're going to transition to a large market. I will talk to you soon.